Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi.
All right, so lots to talk about again this week, and I think we should probably, again, it's worth starting with the UK, given that they continue to drive the volatility. There's a lot of headlines on the Bank of England intervention, a lot on the fiscal policy. So let's start with the fiscal policy. Do you have anything to kind of update us on that front?
Yeah, well, it's like you say, Jan, there's a lot of moving parts on all of those things, I think, at the moment in the UK. Today's driver, I would say, of the market moves has been all about the government. We're recording this on Thursday afternoon, so anyone who closely watches UK markets will know that we're in the middle of a kind of barrage of headlines around whether there will or won't be a U-turn on all of the measures that were announced in the mini budget last 2 weeks ago now. It feels like a lot of the measures that are currently being considered to roll back on, that's being reported in the press, nothing has come officially from the government on this, are some of the smaller, perhaps less costly measures, like just like the top rate of income tax was. But nonetheless, it's kind of helping to support sentiment in the gilt market at the moment. It's been a very volatile day, and US inflation, which we will get to with you, has kind of put a bit of an end to the monster rally that we were seeing on reports of a U-turn. But as we record this now, we're about somewhere between 50 and 20 basis points down in yield in 10-year gilts, although that has been much bigger, like I say, before US inflation. It's still very up in the air. Chancellor Kwasi Kwarteng just made a statement which didn't really contain a lot of new news, but he just reiterated that he would be kind of revising the mini budget on the 31st of August, and therefore that is the key date for markets to watch now.
And how about the Bank of England? They were in the markets for the last 2 weeks, and tomorrow, like you said, we're recording this on Thursday. Tomorrow, it's supposed to be the last day of the operations. Do you think they're going to extend it? And it doesn't matter to markets if they don't extend it. So just give us a rundown around the Bank of England.
Yeah, well, again, it's been a week of kind of back and forth on those headlines, but it seems like the Bank of England are kind of standing their ground on the rhetoric that they will be ending those interventions tomorrow. There obviously are a couple of other measures that they've announced, I guess most notably this kind of temporary repo facility that will extend beyond tomorrow, tomorrow being Friday the 14th as we record this. But the buybacks that they've been doing for the last, just over 2 weeks are supposed to end tomorrow. We've had very mixed results, I would say, of those buybacks in the last couple of weeks. Some, they haven't bought anything at all. And then after the volatility earlier this week at the long end of the link market in particular, they expanded the program to include buying inflation-linked bonds. Obviously, previously, they were only buying conventionals. And in the last couple of days, particularly with Governor Bailey's reiteration that the program actually will be ending on Friday, we've seen a much larger take-up. So just today's operation, they will be, the nominals auction is actually underway right now, so I don't know what the take up was in that today, but in the linker auction we saw just over 3 billion being bought, which is the single largest auction that we've had any day this week. So markets have also taken a bit of comfort from that, I suppose, that the Bank of England actually, have been supporting particularly the long end, I guess, over the last couple of days. Does it matter if they don't extend? Well, to be honest, the market seemed to take the news in its stride yesterday. I think that Governor Bailey would probably be relatively content with the market reaction that we've had over the last couple of days since they announced that it really would be ending on Friday. Gilts were a bit weaker on the open on Wednesday morning, but in the context of the kind of volatile markets that we've gotten accustomed to over the last couple of weeks or months, really, it was nothing to write home about. And obviously the potential for a U-turn or some rollback on government policy is also supporting that sentiment today. I think that there's probably a bigger question out there about how much selling there still needs to be done by pension funds, and how much this latest episode kind of changes the way that they react in the future as well, and the way that they kind of balance their portfolios and think about their collateral that they hold and their leverage ratios as well. So I'm not sure that it would be correct to say that we've seen the end of those selling pressures. Indeed, I think we probably talked last week about how 2 weeks is probably quite a short time horizon for the LDI community that we know are often a fairly slow moving sector of the market, let's say. Given the market moves that we've seen over the last couple of days since the Bank of England, kind of doubled down on this idea that they will be ending purchases on Friday, I'm not sure that they will be overly concerned about this kind of cliff edge effect that there might be on Monday. I think that they can always and will always remind us that if we start to see risks of financial stability, then they can intervene again. But we always said that it was never really about the level of yield that we got to. I don't think that they were particularly divorced from fundamentals. It was just the speed at which we were getting to that. But the market seems to have taken in its stride the news that this will now seemingly with increased certainty be ending tomorrow, and I don't think the Bank of England will be particularly unhappy with how the market has reacted over the last couple of days.
Right, that makes sense. And adding together everything what you just said, and I appreciate that by the time this is out, gilts might have a different handle, but where does that all of this leave your market views?
Yeah, they might have a different handle, but who knows if that's going to be a 3 or a 5. So actually, for all this volatility and for all the headlines and the day-to-day moves that we're seeing, I'm not sure yet that we have enough clarity to suggest that any of this really alters our medium-term outlook for gilts. We've been bearish on the basis of the supply outlook, and so far the measures that are being reported in the press, as in terms of the tax cuts that the government might roll back on, seem to be the smaller measures that were never really the issue in terms of what was making this additional borrowing so much larger this year than expected. So there's still a lot of uncertainty around that. Given Kwasi Kwarteng's statement today, it feels like we won't know more until the 31st of October. So gilts may well be in this limbo for the next couple of weeks and essentially just trading the headlines as we get them. Obviously, there could be a little bit of an upward pressure given that the Bank of England are now quite likely to exit their bond buying program on Monday. But I generally think that, whether the Bank of England delay QT, whether the government kind of roll back on some small tax cuts, it doesn't change the fact that the net supply picture is shifting quite drastically for gilts over the next couple of months and years, really. And unless we see a major U-turn for the government, I think you'd be hard pressed for really revising our gilt outlook from still seeing kind of moderately higher yields from here. So perhaps I can stop there, given that there is still so much uncertainty in the UK. It doesn't feel like I'm giving any concrete answers today. We perhaps need to revisit those next week and in the weeks to come. But let's shift over to the US then, Jan, because the other kind of major market mover today was the inflation print. It's obviously the last inflation print, both before the next Fed meeting, but before the midterms as well, that came much higher than expected in the market. What's your take on that?
Yeah, and it feels like every time we record this mid-month, it gets a little bit like a deja vu at this point, saying that inflation was red hot and came in above expectations, and this month was no different. So as a top line figures, on a headline basis, inflation was at 0.4 on a month-on-month basis, and on a core level, which excludes energy and food, it was 0.6. So both of those are about 20 basis points higher than where market had them marked down. And really the reasons are the bad ones, the services, which make up a large portion of the CPI report, such as shelter, the OER, and the rent measures, which accelerated again. Now we had rents are almost at 0.9 on a rounded basis. They were at 0.844, but nevertheless, we can see the pace picking up from last month, which is a really worrying development, because it is one of those things that once it gets to 0.85, it is highly unlikely that the rate of change there is gonna crash and fall very quickly, but rather it tends to be more of a gradual decline. Similarly, components such as medical cares were up 0.8 on a monthly basis. There's a lot of service-driven pressure that should be worrying for the Fed, given that part of the labor market is still adding to the wage pressures as well as it continues to recover and add more jobs. On the other hand, I guess some goods were showing moderation. Things like used cars fell another month in a row, a little bit less than expected by another percentage point for the month. But those things are not enough to just drag the entire index much lower, and rates reacted accordingly, with selling off and immediately kind of repricing the entire curve, a little bit higher in yields, but most of the front end.
I guess the major question then is what does this mean for the Fed? I suppose that central bank pivot theme that markets were getting so excited about last week is dead in the water now.
Yeah, it's looking pretty short-lived, and so it's not good news for the Fed. And the next thing that the Fed will be looking at is the employment cost index on the 20th of October, which measures the wage pressure side of the whole inflation picture. But I think the main implication is that this inflation print seals the 75 basis point hike for the November meeting, and certainly increases the odds of a 75 in December. But there's some time until then, and it's not like a guarantee. I think it's still closer to 50-50 right now. Our forecast for where the Fed ends this cycle is at 5 percentage points, which is at this level, after the inflation number was released, just above where the market's pricing it. Terminal has settled around 4.9 before I walked into this recording, but we are for the time being we're more or less comfortable with that. We'd rather be generally above where the Fed is with their forecasts, because we do see risks as continue to be skewed to over delivering, over tightening rather than pulling back. But I guess there's a couple of, one silver lining for the Fed is that inflation expectations are still fairly well anchored, and these comparisons to the 80s, when the Volcker Fed really increased rates to double digits, was mostly because inflation expectations were kind of like losing, markets were pricing really high, or I guess like consumers at the time were implying that consumer expectations were super high, and the Fed wanted to control that. That's not the case right now. However, and the central bank can't really continue to react to spot inflation forever. So if we see unemployment turning around and starting to increase, and if we kind of start seeing this economic pain materializing, then it might be a little bit harder for the Fed to keep maintaining this pace. So at some point they'll slow down, but of course this leaves the risks for kind of like the so-called terminal rate where the Fed will on this cycle to be again above 5%. We're not making any adjustments yet. We'll be looking for the next month's numbers, but and we could also see the December economic projections to be a little bit higher again, implying something close to 5% in rates.
Okay, that makes sense. Thank you, Jan. All right then, Giles, let's head over to Europe, which I'm happy to say you're reporting live from, because it feels like it's been all about the UK and a little bit about the US this week, but of course it hasn't all been quiet in Europe either. A lot of central banks speak this week, I guess most notably a very lengthy speech from Philip Lane, the chief economist. What's the key takeaways from what we've heard from them this week?
Well, okay, so I think that we're very unlikely to change our basic call for 75 basis point rate rise in October. And thereafter, while our call is for 25 basis points in December, I think that the markets are probably fairly pricing that one as well at this point. So from the Lane speech in particular, yes, you're absolutely right. It was incredibly long. It was almost like a brain dump of everything that he's ever thought about monetary policy, to be honest with you. But now, if I just draw out a couple of things, he was talking about analytical tools that seek to draw on historical evidence, and I'm quoting here, in the most informative way, recognizing the relevant differences across different inflation periods. And then he goes on to talk about lags, and the role of monetary policy being to ensure that the residual inflation dynamic returns to target in a timely manner. What does that mean? I think what he is doing here is trying to prepare for a slowdown in the pace of rate hikes. Of course, we're not necessarily suggesting that's going to be this year, but I think he's trying to prepare the way for that. And I was going to say pivot clearly isn't the right word in this. It's come to take a different meaning in this environment, I suppose. But for lack of a better word, a sort of change towards trying to focus again on frameworks and forecasts, and not merely on closing the gap and catching up in rates.
I guess the other important rate discussion that's been going on this week, or for the past couple of weeks really, both in the UK and in Europe, and something we've been talking about, but I don't really know if we've talked about it much on the pod, is with regard to tiering. And I guess this matters most in Europe, given TLTRO and the favorable, I don't know if that's a real word, favorableness of the rates there, and what that means for banks and the profit, I suppose, that the ECB is distributing to those banks. What's your view on that?
Yeah, I mean, I suppose the first thing to say is that that's also been a topic of conversation in the UK, but of course there's so much else going on there that it would be a waste of space to talk about tiering in the UK context. As you've been writing, we don't really expect that to really be a big issue. In Europe, it is something that people want to talk about. And there was a Reuters article today talking about a sort of long list of 5 options on the table that the ECB was discussing for tiering, been whittled down to 3. It sounds like the main options would be pretty much targeted at removing the benefit of the TLTRO altogether. They were talking about 30 to 40 billion total cost for the banks. Now that seems like approximately what you would, where you would cost the benefit to the banks from TLTRO just retaining its current level of attractiveness over the next year, for example. So it sounds like that's what they are aiming to do. It all depends on how they do it, of course. Anything that pushes reserves back towards Southern Europe, Italy and Spain in particular, from Benelux, might have some impact on assets in those countries, particularly front-end assets, maybe repo as well. There are some other questions that I think we'll leave for another time, perhaps next week, when hopefully we'll have the benefit of our having done the work for our ECB preview. But perhaps there's a story around the tail risk of potential ECB sterilization, which obviously would have much more dramatic and but equally easily foreseeable consequences in money markets. And so this is a bit of a live question, and I guess one that we'll come back to, but very much something which we're expecting to be hearing announcements on at the October meeting.
Okay, great. Well, I will look forward to revisiting that topic and all the other things that we discussed today, I guess most notably what's going on with the UK fiscal policy and also the Bank of England's interventions next week and in the weeks beyond that. Thank you both for joining me. And just a reminder to my listeners, if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.